As we've had a little back and forth here, my name is Nan Lesnick. I'm a personal financial coach, and I am the instructor today with American Financial Education Alliance, or AFEA, as we call it. AFEA is an IRS-approved 501c3 nonprofit organization. So we deliver information about subjects that are important to people as it relates to money. The goal with this seminar and every other seminar is to elaborate on the essential knowledge that you need to have when you're making Social Security decisions, when you're deciding where you should be on the benefits. What are your options, and what do you need to know? So we are personal financial coaches, and Kelly and Tom and I are all personal financial coaches and instructors on a volunteer basis with AFEA. But I want you also to know that that's a moonlighting job, shall we say, we volunteer for that. But I want you to be aware that our real job, and my real job, is as a financial planner. I'm focused on retirement income strategies, and in our practice, we advise people on strategies, and we manage accounts for our clients. So I didn't understand much about Social Security when I first began my career in financial services. Now, that was a while ago. As you saw a shot of me on the screen at the beginning, and you see this, that is me with the name tag Nan on there. And I think that many people watching this would recognize the gentleman that's sitting there with me, Marlon Perkins. I began my career in financial services with Mutual of Omaha, and I actually had a jacket like that at one point in time. I got rid of it, not knowing, that it was going to come back into style like it did. But I just want you to know how long it has been that I've been in this field. So I want you to keep questions that you might ask later in the meeting general. If you put questions in the chat box, we'll get those. And if you have any specific questions, please take advantage of a 15 to 20-minute complimentary phone consultation. So part of our service as AFEA instructors is that for all of our classes, we offer a follow-up private conversation, because sometimes people have a question that didn't seem to get answered, and with the time that we have available, obviously we don't want to focus on only one person's issues. So we're committed to helping people. We're committed to helping you understand your personal financial situations. So please don't hesitate to schedule the 15 to 20-minute phone conversation. There is a link in the chat box to my calendar so that you can get that meeting scheduled. Okay. So there's no cost or no obligation. We will be discussing Social Security at that in that conversation. You will also get a link to an evaluation form at the end of this seminar, and that's specifically for AFEA. In order to continue to serve as an educational organization providing no-cost education and maintain the 501c3 status, we have to help AFEA maintain their attendance records. So we appreciate you completing that at the end of the course. The nonprofit mission of AFEA is to inform and empower Americans to take control of their finances by providing comprehensive financial education in communities nationwide. And by the way, be sure to let us know if you want to know about every seminar or presentation that we do. I think you can do this with the directly in the AFEA dashboard, because not everything that we do is with the Bulverde library. We do things in the Bernie Library. We do things in other areas. But now that we're all virtual, you may be able to attend something that's on a different time schedule. So we want to be sure that you take advantage of that if it's of importance to you. A little bit of information about AFEA, how AFEA is funded. Primarily, AFEA is funded by chapter sponsorships. Lesnick Company is a chapter sponsor. We also, from time to time, receive personal donations. There are some advanced courses that are tuition-based, and then also there are membership dues, not to you as people who participate, but to professionals who want to be members of AFEA and be part of the educating network. Okay. So one of the things we want to encourage you to do is to become a member. Okay, there are multiple financial tools and resources. It says here it's all free. There are 30 different financial calculators. You'll always know about AFEA events that are in the community. And that was where I said earlier, if you register for this, you'll know every AFEA event that's taking place and can choose those that apply for you. You can attend all of them as many times as you wish, actually. And then one other thing that you'll get is direct access to message me as the personal financial coach, because you could be, let's say you're 63 and you're not planning to access Social Security for a while, and next year you think, oh my gosh, I don't remember what went on. You will always be able to reach me through that dashboard with any questions or concerns and to get more information. So when you create your account, you'll see on the slide there, it's myafea.org. I think you can read all that. It's more confusing if I read it to you, I think. But be sure to mention the chapter ID, which is 4636, okay? And that's what would link you to me and to Lesnick Company, so that if you have questions, we'll be able to identify what event you attended. Okay, now the next part. I know that we all love these kinds of things. This is a disclosure that I am required to read in its entirety. Now I want to tell you that this is like every other disclosure you've ever seen. There are things that are mentioned here that have no part in today's presentation, but I get to read it to you anyway. AFEA, the American Financial Education Alliance, is recognized by the IRS as a 501c3 nonprofit charitable organization that provides educational workshops and classes in businesses and universities nationwide. Our instructors are licensed and trained financial professionals with a minimum of 5 years real-world experience in their field. They've been required to pass a series of training sessions on how to properly educate in a not-for-profit setting before becoming a personal financial coach and instructor with AFEA. AFEA courses and workshops do not promote or endorse any specific products or companies, and no selling is allowed. AFEA educational workshops and courses are for general education only and are not intended to be construed as investment, tax, legal, or financial advice. Attendees should seek the assistance of a professional familiar with the course prior to implementing any of the ideas or strategies taught or discussed in the course. Hypothetical and/or actual historical returns contained in this presentation are for informational purposes only and are not intended to solicit, or to be an offer of solicitation or recommendation. Rates of return are not guaranteed and are for illustrative purposes only. By the way, there are none in this presentation. And there's none of what follows either. Projected rates do not reflect the actual or expected performance of any example or financial product. Past performance does not guarantee future results. The presentation is not intended to be legal or tax advice. The presenter can provide information but not advice related to Social Security benefits. Clients should seek guidance from the Social Security Administration regarding their particular situation. The presenter may be able to identify potential retirement income gaps and may introduce insurance products such as an annuity as a possible solution. Social Security benefit payout rates can and will change at the sole discretion of the Social Security Administration. For more information, please direct your clients to a local Social Security Administration office or visit www.ssa.gov. Thank you for your patience in listening to that. So let's move forward up here and show you that the OWLI shows up every time there's something that we think as instructors and AFEA thinks we need to emphasize a little bit more. So when the OWL shows up, we will elaborate, okay? I want to be sure that you take lots of notes because this information is all for you. Enjoy the class. So let's get going here. So what is Social Security? To the average earner, Social Security will only replace about 40% of their income. Okay? Assuming that you're an average earner who will need 80 to 100% of your pre-retirement income at retirement, the percentage is lower for people in the upper income brackets and higher for people in the lower incomes. And of course, you're going to need to supplement your benefits with a pension, savings, or investments. So as you can see on this graph, 60% of income we expect to come from a different source. So the complexity of Social Security is fairly overwhelming. There are multiple claiming strategies. There are 81 different age combinations and more than 567 different sets of calculations to consider when you're determining how and when to apply for benefits. So it only goes to reason that making the wrong decision could cost well over $100,000 during your lifetime. As a matter of fact, I used to start my presentation by saying choosing the wrong retirement strategy could cost you hundreds of thousands of dollars, and that's oftentimes true. I will cover this at the end, but I want to be sure that everyone realizes that taking advantage of the call is very worth your while, because we will actually do a Social Security analysis in that call and provide you with some really valuable information, some various scenarios. We have some wonderful software that will tell us the scenarios that are available for you and allow you a starting point from which you can really focus on the best Social Security strategy for you. So one of the questions that people ask all the time is, will Social Security be there? Okay. As a matter of fact, I received an email from a client today who actually has kind of a lot of fear about this situation. Well, there's reasons to be concerned. I'm not going to say there's reasons to be fearful, and I'll elaborate on that a little bit. But this is interesting. In 2009, it said on the statement, on the front page of the statement, in 2017, we will begin paying more in benefits than we collect in taxes, okay? Well, one of the things that I want you to keep in mind as we move forward in this is Social Security began in 1935. And at that point in time, most people were expected to live to age 63. So Social Security not becoming available until age 65 wasn't planned to be the basis of every American's retirement. It was designed to benefit a very few lucky souls who lived longer than expected, or to take care of widows and orphans. So as it was designed actuarially to achieve that, you might imagine that that is a flawed strategy now, and it's why we continue to have some of the difficulty, shall we say, in knowing exactly what the financial condition of Social Security is. So in 2010, okay, let me go, I want to go back just a moment. In 2009, it said in 2017 we will pay more. Let me go here. In 2010, it said in 2016 we will begin paying more. Okay, the number changed there. And then in 2014, the statement said without changes by 2033, the Social Security Trust Fund will be exhausted and there will be enough money to pay only about 77 cents for each dollar of scheduled benefits. So the truth is, they don't really know, okay? That's what the reality is. They don't really know what condition Social Security is going to be in the future. But I do want to step back one moment on this slide and tell you something that I know from the reading that we do, and that is there are continual efforts to keep the Social Security fund or the Social Security program balanced. Oftentimes people say in seminars, when did they start taking money out of the Social Security Trust Fund? Well, it actually was not designed to be a trust fund. It was always designed to be a pay-as-you-go system. But an excess was collected and therefore a trust fund was set up. But that's not how it was originally designed, okay? So what we do see happening is moves towards reform. We have seen some of those reforms take place already. 65 used to be the retirement age. Then 62 was introduced as an early retirement age. Then the reform came that moved the full retirement age up to age 66, and then 66 in 2 months, 4 months, 6 months, 8 months, etc. And finally, now the full retirement age has set at 67. My personal belief, based on the length of time I've been in this business and the things that I see, it's probably going to be moved up. That will not affect people who are currently receiving benefits, and it's unlikely that it will affect anyone who is close to Social Security age. But as people begin to live longer and people are regularly working into their 70s and sometimes into their 80s, it makes sense that this system might be a little bit outdated. I'm very happy to answer your questions about that later or in a call. So let's move on. So you might find a little kind of interesting to know this a little bit. The first person who received the Social Security benefit, his name was Ida Mae Fuller. She was a legal secretary. She was from Ludlow, Vermont, the very first person who received this, okay? She received Social Security checks on a monthly basis until her death in 1975. So by the time she died at age 100, she had collected $22,888.92 from Social Security monthly benefits. She had worked only 3 years and had contributed only $24.75 to the program. So you can see that the program was likely flawed from the very beginning. So we are all aware of that, I think. When you start receiving Social Security checks, the question that we want to ask ourselves is, will it be enough? Remember that Social Security typically only covers 40% of most retirees' income needs. And the question that you need to ask yourself is, will it cover 40% of my needs? And what other sources will I have when I retire? And you also want to be sure that you're asking yourself the right questions. Are any of these sources guaranteed to provide income throughout the years of retirement? And another thing to ask yourself is, what about your spouse? If you're a married person, what about your spouse? What are your spouse's benefits, and how will your benefits be affected, or your spouse's benefits be affected by the other's collection? We'll get into that a little bit. People who have public pensions and some other issues that kind of muddy up the waters for clear understanding. One of the most important decisions, though, you need to make before you retire is when and how to collect your Social Security benefits. So that's what we're going to focus on today. About half of today's retirees claim their Social Security benefits as soon as they become eligible at age 62. But that needs to be examined, okay, if that's what you're thinking about doing. They may be, because if you're doing that, you are significantly impacting your lifetime income. And that impact is essentially permanent. Simply by waiting to claim your benefits until full retirement age could increase the payments by as much as 8% per year. And going beyond that period of time, beyond full retirement to age 70, makes it an even larger benefit. So the number one question that people ask, and ask themselves, and effectively ask financial advisors is, will I outlive my money? When people come to see us, when I say, what brought you here today? They say, I want to be sure that my money lasts as long as I do. So 54% of Americans, it says here, are worried about not being able to maintain their current standard of living. So there's a little indication here about from the Owly conversation, okay? And that is, how much money do you really have, okay? So why this is brought to our attention here is to say, when you're trying to determine whether or not you'll run out of money, you'll have to first determine how much you really have. Okay, so about 95% of the people who attend these classes have money that is considered qualified, or in other words, has never been taxed. Okay, and that would be something like the 401k, or an IRA, or some other kind of a deferral program. Most people save money these days in their company 401ks, and then they roll it over into an IRA when they retire. Now, the problem with this, although you may save money on the taxes that you pay today, is you're going to pay taxes on all the money later, and that might be a higher rate. And also, now at age 72, you must begin to take contribution or distributions from the plan that you had contributed to throughout your working years. So if you couple that with your maximized Social Security income, you could be paying even more in taxes than you're paying now if you're still working. So we all know the debt problem that the country has, okay? We don't even need to think about what has been added this year. It's because it's unthinkable, I would say. Before this year, we had over $21 trillion in debt. So is it likely that taxes will go up in the future? I think so. So one of the things that you want to do when you're looking at your brokerage account, and if you've got an IRA that has $1 million in it, if you're in a 25% tax bracket, you may not have $1 million. You may have $750,000. And that, because you owe 25% of that to the government in taxes. Now, here in Texas, we don't have state income tax, fortunately, but we still have federal income tax. So it's really important that you grasp the combination of all of these sources of income. Because if taxes go up in the future, which many of us think they will, you'll fall even shorter. So if you have an emergency, if you need long-term care, and your savings are in a qualified account, your plan could falter even sooner. So in this scenario that I just mentioned, $1 million in a 25% bracket, $250,000 of that million isn't yours, and it never will be. And the problem that concerns me in dealing with clients is that might be an even greater liability that you have. So it's probably going to cost you more than that in the future. So an important part of planning is to really evaluate your tax situation along with your streams of income. So the next slide here is, I guess it's a little bit of humor, but according to statistics, I have better than a 50% chance of living to the age of 87. And what's wrong with that is you can't afford to live that long. And a lot of people say that. It's put into a humorous frame here, but it's not really funny. As a matter of fact, one of our colleagues in the business says that if you are concerned about a shortfall in your retirement savings, you don't begin to show concern or have anxiety about it the day it happens that the shortfall hits. The anxiety is with you throughout the period of time leading up to that. So I think that that's a really important reason to get a grip on this and know what's what. All right, so let's talk about the Social Security options, okay? When you're considering your benefit options, there's 3 pieces of the puzzle that are can potentially enhance your retirement income. And they are determining what your Social Security benefit will be, understanding what your options are, and maximizing your lifetime benefit. Now, I want to stop right here, even though it's addressed later on, and say maximizing your lifetime benefit does not necessarily mean that everyone should wait to age 70. Okay, I want to be clear on that. What we want to be sure that we're focused on is understanding where your Social Security benefits fit in all of your various streams of income. So the first step is to determine what your Social Security benefit might be. So you get a Social Security statement. We used to get them in the mail. We don't, I have to tell you, I deal with this all the time, and I cannot tell you why you sometimes get a Social Security statement and why you don't at other times. It seems as though everyone gets one at age 62, although I had a client who's age 60 who said she just got one. I'm not really sure why. I think that the best way to handle this is to go online to ssa.gov and create an account so that you can view a Social Security statement anytime you wish to do so. Okay. But the basic rules are, if you have worked and accumulated a minimum of 40 work credits, essentially 40 fiscal quarters, or about 10 years of work, you are entitled to receive Social Security retirement benefits. Now, again, I want to stop here and say that those do not have to be 10 consecutive years, because we are often asked that question. The Social Security statement will summarize your earnings, and it will show how much you and your employers have paid into Social Security and Medicare taxes. I want to just slight sidestep to Medicare for a moment. That Medicare tax that you see, that you'll see it in your statement, and you'll also see it sometimes in your paycheck, depending on how elaborate the accounting is on your paycheck. That is what is paid during your working life for Part A of Medicare. After you reach Medicare age and are enrolled in Medicare, you no longer pay that Medicare tax. Okay, that's not something that goes on beyond employment. Okay, if you're the spouse of an eligible worker, you can collect Social Security benefits regardless of whether you worked or not. Now, this is something else that's commonly misunderstood. Sometimes people who have a small business will say, I put my spouse on the payroll so that he or she could accumulate 40 work credits so that they would be eligible for Social Security benefits. I will tell you that that's number one, not necessary, and number two is usually detrimental to family income. And I can answer that in a particular situation. But if you lower your if you are the primary earner in the family, and you lower your earnings by, let's say, 25% in order to put that money in your spouse's Social Security account, the overall outcome will not be better, because you will minimize that maximum benefit, and the money that accumulates in your spouse's account will never equal what could have been in the spousal benefit. Okay. All right. So we've got another addition here from Owly. Okay. And what that's telling us is that your PIA, okay, and you'll hear that referred to by me and by other people who work with this, that's the amount that all of your benefits are based on. So if you collect early, okay, if you collect at age 62, it is based on what your benefit was expected to be at full retirement age. If you are claiming a spousal benefit, it is based on what your spouse's PIA was at full retirement age. If you have children, dependent children, and you are Social Security, you are eligible to collect Social Security, their dependent benefit will be based on that PIA. So it is determined by the average of the highest of 35 years of indexed earnings in which you paid payroll taxes. If you were employed less than 35 years, or you worked part-time, or had long periods of unemployment, the years in which you had low or zero earnings will be averaged into your calculation and might lower the total benefits available to you. Okay. So that's important to note, and it's the reason why you need to look at that page that has recorded. It's when you open the Social Security statement, it is the page that has all the years and the amount of benefit that was or amount of earning that was credited to you. Now, I will tell you, if 1 year is missing, it usually, and you know you worked that year, that's usually not consequential, but you should have that looked at. Okay, you certainly should have that looked at, because we don't want you to be missing anything on which you paid the contribution. Okay, so I mentioned earlier to set up a Social Security account online. That's the best way for you to get information. So go to ssa.gov/myaccount. You create your own personal Social Security account there. Now, I make jokes about this, that if you were ever inclined to get a tattoo, but you didn't know what you would have your tattoo be, you would want it to be your username and password for the Social Security website, because if you lose that, I mean, first of all, they're horrified that you don't have that information, and it's pretty difficult to get back online. So be sure you put that information in a secure place, okay? It's also the place that you would go to update your address if you have moved, and it also allows you there to change your direct deposit data. Now, this is something I want to tell you that's the most important shall I say, must that I will share with you, and that is you absolutely must have direct deposit for many, many, many reasons. If you do not, I don't even know if you can go without direct deposit now, but there are some people who we work with who still do not have direct deposit, and when something goes wrong, it's a nightmare. That said, I want to give a shout out here to the Social Security Administration, because never have I, nor my instructor in my Social Security training, never have we seen the Social Security Administration not correct errors as long as the data is correct. It seems impossible that a government computer system could always, it could be completely accurate, but we have never found Social Security to be inaccurate so long as the information that they have is correct. Okay, so again, establish that account because that's the best way for you to know where you stand. So now what should we talk about? All right, we're going to talk about the various definitions that are used by the Social Security Administration and what those various things mean. We get in trouble right off the bat when we talk about eligible versus entitled. Now, I don't want to get any emails that say it is not an entitlement. I paid into that system all of my working years, okay? We're gonna cover that. It's a different, doesn't say entitlement, it says entitled, okay? We're gonna talk about the WEP and the GPO. Those are the things that affect you if you worked under a government pension plan. We're going to talk about COLA, cost of living adjustments, claiming ages, working after you make your claim, taxation and benefits, spousal benefits, and common claiming strategies. So let's start right up by digging into eligible versus entitled. An eligible worker is one who has accumulated the minimum number of credits for Social Security benefits and is at least 62 years old. An entitled worker is one who has applied for benefits, whether or not they are receiving the benefits or have suspended them. Okay. Now, we don't have very many people left who have suspended benefits. File and suspend was a strategy that was used in the past that is no longer available. So I won't spend a lot of time on that. But an entitled worker is one who has applied for benefits. And sometimes we have someone who is disabled and they have applied for benefits in order to get the family benefits that they need. So that's what entitled means. What about WEP and GPO? WEP is the windfall elimination provision. This is what reduces your benefit if you receive a pension from a federal, state, or local government based on work where Social Security taxes were not taken out of your pay. That's the very simple way to know whether or not you will have a WEP penalty. Okay? If you did not have Social Security taken from your wages in the job that you're considering the pension payment from, then that would likely be subject to windfall elimination provision. In some places, counties especially, I have found, they have a public pension and they have also chosen to stay in Social Security. I spent many years, about 18 years practicing in California. And in California, in many counties, they thought that they would stick with Social Security even when they were allowed to opt out. And people thought, oh my gosh, I'm paying, you know, I'm having this taken from my pay and I'm also accruing this other benefit. It just doesn't seem right. It was 6% of their pay, okay, on an average. Maybe it's probably more an average of 5%. I will tell you that people who are retiring now, who have a public pension and Social Security, are saying, whoa, I was never complaining about that. I always thought it was a good deal, and it was. But the government pension offset, okay? The government pension offset reduces your spouse's or widows or widowers' benefits if you receive a pension from a federal, state, or local government based on work where you did not pay Social Security taxes. So if your spouse's benefit may be negatively affected by a GPO. Okay? Now, an important thing to know is this information can be calculated on the website. So if those provisions do apply to you, one or the other of those, you can find out what the impact will be on the Social Security website. And that's something on an individual basis I can help you through. Okay, so let's talk about the next thing, the cost of living adjustment. Okay, now, cost of living adjustment is intended to provide inflation protection. This is actually a slide that I edited because you'll see here at the bottom where you see Owly showing up on this, that we use a 1.5% number. Social Security Administration suggests you use a 2.5% number for the cost of living adjustment. I don't like that, because what you can see is 1.5 and 1.7 and 0 and 0.3 and 2.0. Whoop, here's one over 2.5 or 1.6 in 2020. Those do not look to me like an average of 1.5, therefore, or of 2.5. Therefore, we're more comfortable in using a 1.5% cost of living adjustment factor. And the analysis that we'll do for you in a phone call, we will use a 1.5% adjustment. I'm sure we could argue with the authorities on that all day long. It probably wouldn't get us anywhere. It's just better to err on the side of caution. I think we'll all agree. All right, so now let's talk about claiming age. The earliest time that you can claim is at age 62, okay? The full retirement age now is either 66 or 67, depending on the year of your birth. And the latest claiming age is 70. See, I was just going to tell you that people are confusing that with required minimum distribution, and there I went and said it myself. The latest age is 70 for Social Security. Required minimum distributions from qualified plans, IRAs and so forth, is now 72. And I say, don't confuse those two numbers like I just did. Okay. These ages are important because they affect how much your entitled benefit you will receive and when. So keep in mind that if you were born between 1955 and 59, your full retirement age is going to be 66 and 2 months. Actually, let me say that better. If you were born after age 59, your full retirement age is going to be 66 plus 2 months for each year past 1954 until we get to 67. Okay. You will find that answer for what your number is when you are fully retired by looking at that, or fully eligible, when you see that Social Security statement that you can get online. Okay. So let's talk about the pros and cons of claiming early. So claiming benefits at age 62 would allow you to receive your benefit early, but it permanently reduces your lifetime benefit by 25 to 30%, depending on the year in which you were born. You may be subject to a reduction penalty if you're employed, but we're going to talk about that a little bit later. Okay. If you choose to wait until your full retirement age of 66 or 67, you would receive 100% of your primary insurance amount or your PIA, and you would not be penalized if you work. Okay. So this would mean that you would not receive benefits between 62 and full retirement age. Okay. Now, claiming benefits at age 62 would allow you to receive your benefits earlier, but it will permanently reduce your lifetime benefits by 25 to 30% again. Okay. If you choose to wait, sorry, I just noticed that I may have clicked a little too quickly, but I think what's really most important is to know that you're penalized prior to your full retirement age, and you are rewarded if you wait beyond full retirement age. Your monthly benefit would increase by 8% per year, okay, if you are claiming at age 70 or beyond. And that would make your benefit, if 66 was your retirement age, it would make your benefit 132% of your PIA. It's important to note, though, that there's no advantage to waiting beyond age 70. Okay, and as I mentioned, that 70-72 confusion comes in there. Okay, now there are reasons why someone may want to collect early. Someone who has a health concern that frankly makes them wonder if they would actually live to full retirement age. Sometimes people desperately need the money, but I think that it's really important to look at these options and talk to someone who works in this field if you're thinking about claiming early. Okay. Also, another thing for you to know, that if you did claim at full retirement age because you needed that income, perhaps there was and especially in this time that we're in, with people having had their wages cut or eliminated, or having been affected by this COVID situation, you may say, you know what, we really need to have that additional income. I want you to know that if you're continuing to work, you can actually be increasing your benefit. As a matter of fact, you will be increasing your benefit if you're working beyond full retirement age. You will give up that 8% addition that you would have by waiting to age 70, and no matter how much you earn, you will not overcome that. So that's, shall we say, it's a goal worth considering. Okay, now let's get into some definitions that are used, because I think it's always important to know what these words mean in various contexts. Deemed filing requires that a claimant filing for any benefit before their full retirement age must file for all benefits available to them at that time. For instance, if you're filing for your own benefit and you are also eligible for a spousal benefit, you must claim that spousal benefit when you become entitled. Okay? But there is also a restricted application. Okay? That's, on the other hand, it is available to workers who have reached full retirement age, and it allows them to restrict their application to their spousal benefit only. A spouse might file a restricted application for spousal benefits while delaying collecting their own benefits on their own work history, thus allowing them to grow. Now, there's a strategy that I suppose there are people out there that figured this out, but usually this is an aha moment for saying why there is something that we can do that we weren't aware of. So the voluntary suspension, okay, is another option that's available if you've reached full retirement age, and that's what we've talked about, to earn the delayed retirement credits. So these benefits would continue to grow to age 70. But if you do that, your spouse is not able to file for spousal benefits. That is the change that happened in a few years back, 2015, I believe it was, 2017, I'm sorry, where you could file and suspend, and that allowed your spouse to collect. It's not allowed anymore. It hasn't been allowed for several years. So we're going to talk more about how these strategies might help you as we move forward. So let's see. When should you start taking your Social Security benefits? Well, it depends. Okay. The premise of waiting, excuse me just a moment, I need to take a sip of water, a lot of talking, and I'm losing my voice there. Okay. The premise of waiting until your full retirement age makes sense if you expect to live a long life. In essence, if you drew 132% of your benefit at age 70 and lived to age 79, you would not have benefited from the delay. But every year thereafter, you will have benefited from delaying your benefit to age 70. So if you come from a family like my husband did, where his grandmother lived to be 98, his mother lived to be 95, his father lived almost to 91, probably a good move for someone like him. And also because we have access to modern medicine, and we're much more physically fit. Just think about what your granny looked like when you were a kid, and now you may be a granny and saying, we don't live our lives the same way. We're living longer and healthier lives. So you might want to consider this strategy. But there are compelling reasons not to wait, okay? If you're not in good health, let me go back for just a moment. If you're not in good health and your life expectancy is less than most people, then by all means, start taking your Social Security benefit as soon as you are able to do so. We're not going to talk about Social Security disability here, but I will tell you that Social Security disability is very strict rules, and unlikely that many people who have mild health problems would be eligible for Social Security disability. So you want to know the break-even point, and that analysis that I will do for you will tell you that. Okay, so let's look at this. So when should you start taking benefits? Okay, well, it depends. Okay, the white horse here represents your assets, and the black horse represents Social Security. So the premise of waiting until your full retirement age makes sense if you expect to live a long life. In essence, if you drew 132% of your benefits at age 70 and lived to age 79, you would receive the same amount of money. Again, as we said earlier, that it would be the same as if you had claimed you don't make out on that until you reach age 80. But there's another situation that needs to be considered here, and that is, if you delay Social Security, are you cannibalizing assets to the point that you will never recover? If you're drawing too much from your asset base and because you want to delay your Social Security benefit, you may be putting yourselves in jeopardy unintentionally. So that certainly is worthy of examining with your advisor or asking better questions about that. Okay. There's also tax consequences. Okay, if you take a smaller Social Security benefit and more from other taxable income sources, you may actually be raising your total tax liability. We do another class called Taxes in Retirement. We've actually done that through the library last month, I believe, and it's very informative to people to understand the impact of these various streams of income from a tax standpoint. So you want to it's really important that you get a good handle on how all of this will affect you in retirement. So most advisors, we find, don't give a lot of advice on Social Security planning, and they also don't give a lot of advice on distribution planning. We think distribution planning is all about not just how much you need, but how is it going to be taxed. So if that's not part of the planning that you have done, it's certainly something you need to look at. So it all comes down to which horse you ride first, okay? You have to determine that. So it's our recommendation that you talk with advisors who know the consequences from a tax standpoint and are able to map them out for you. So let's talk about how working impacts Social Security benefits. If you have claimed Social Security at age 62 and your full retirement age is age 66 or 67, your benefits will be reduced based on how much you make. and your age. If you do have benefits reduced or withheld, then Social Security will recalculate your benefits for retirement age, and you may actually receive more money based on the benefits that were withheld. Now, I want to tell you that that's almost impossible to calculate, okay, because there are so many variables. Generally speaking, if you intend to keep working, you need to make a decision as to whether or not that's going to be part-time employment and be aware of what the earnings ceiling is if you're wanting to collect your Social Security benefits at age 62. It can get really complicated, and it can the complication can continue well past your full retirement age, because if you owe money back to the Social Security Administration, they take it out not in a lump sum, but they spread it over a period of time. It can literally, and I'm not fooling you when I say it can be years before you really understand completely what your Social Security benefit is for the rest of your life. Because other income like government benefits and investment earnings and so forth may not affect your Social Security, but if you are drawing from an IRA or a 401k, those are considered to be earned income, and they will in fact be included in gross wages. So I want to read from this slide exactly what it says because this is an area where people are very often confused, and justifiably so. In the year in which you reach full retirement age, you can earn up to $48,600 per year before the month you reach full retirement age without any withholding, without any penalty. Pay attention to that first part that I read here. Let's go back over it again. You can earn up to $48,600 per year. People have been confused that they could, if they were $100,000 earners, that they could start collecting Social Security after they had been paid $48,600. Okay, and then they could, the following month they could be paid Social Security. That's not the way it is. It's $48,600 per year. So if your wage is in that category, you can in fact begin collecting your Social Security benefit at full retirement age without penalty. I'm going to give you my bottom line on this. If you don't need the money, you might cause yourself more trouble than it's worth to try to figure out whether or not you're under that threshold. The reason that I say that is because I've had a client who had it all figured out and then found out at the end of the year when they got their W-2 from their employer that their employer imputed income in their wages for dependent medical insurance, and all of a sudden their Social Security was, as the saying goes, screwed up, and it stayed that way for a couple of years. So it's worthy of having a very careful conversation. And I might say at this point in time, with all due respect, people who work for the Social Security Administration are very willing to help you, but they're not advisors. They are people who deliver the information about the benefits that you have available to you. They don't take into consideration, nor are they permitted to take into consideration what your other sources of income might be. So you might not get the information that you're looking for there. But just stick with, if you are turning full retirement age in a year, tread very carefully and with great counsel before you take Social Security benefit in that year. All right, let's talk about provisional income. So provisional income is the sum of all of your income, including tax-free municipal bond interest, plus half of your Social Security income. Okay, this is because we're talking about how benefits are taxed. Okay, so you need to get a clear understanding of this. It's wages if you're employed. It's 401k and IRA distributions. It's interest and dividend income, again, including interest on tax-free municipal bonds. It's capital gains, pension plans, taxable portion of an inheritance, if applicable, and any other taxable income sources. Okay, that's what comprises provisional income. So Social Security is taxed in this way. If you are a single filer, if your provisional income is under $25,000, there is no tax on your Social Security. This is on tax on Social Security. If your provisional income is between $25,000 and $34,000, up to 50% of your benefit is taxable. If you're over $34,000, up to 85%. Okay. In the married filing jointly, under $32,000 of provisional income, there's no tax on your Social Security benefit. You see that next tier between 32 and 44 is up to 50%, and over $44,000 in provisional income, up to 85% of your Social Security benefit is taxed. I will tell you that when people have a 401k, an IRA, a pension, almost without exception, 85% of their Social Security benefit is taxed. Okay. So let's talk about, oh, here, I forgot to mention this and the owl is reminding me. It is noteworthy that these tables have been the same since 1985. So if a married couple required $40,000 to maintain their standard of living and one of them dies, you're still needing the $40,000 to maintain the surviving spouse's lifestyle. What changes, if any, would take place with their taxes? And this is something that people often don't think about, okay? If you look at the table, okay, they still need to have $40,000 to maintain the lifestyle. They would lose one Social Security benefit. The larger Social Security benefit would be maintained. So if you died and your spouse had the higher benefit, your spouse would maintain his or her benefit. If your spouse had the higher benefit and died, that higher benefit becomes yours, but the other benefit goes away. Okay. Also, it's likely that taxes will be higher because taxes in a single filer, there's a different tax rate. So it's pretty much of a double whammy. Your taxes, your income will go down and your taxes will likely go up because taxes vary based on your earnings and location. You want to consult with an advisor about your specific situation. And that is, I think, a very important thing to remember. All right, so let's talk about how can you reduce or eliminate tax on Social Security income. The first one, delay it, of course. If you're able to reduce, if you don't receive the benefit, then you're not going to be taxed on it, okay? So you can postpone that benefit. Or you can reduce your other sources of income that are calculated in the provisional income. And these include wages, if you're still working, as well as non-wage sources of income that include distributions from 401ks and IRAs, interest, dividend income, capital gains, pension payments, taxable portion of inheritance, and any other taxable source of income. In fact, even interest earned on tax-free muni bonds, as I mentioned before, is included in provisional income. Okay. Now this is right here. I want to step away from this just a little bit because I want to be sure that people understand that good tax planning sometimes is able to start well before it's time to collect Social Security benefits. And you can make changes from how you are contributing to retirement plans, either on your own or at work. And so Roth 401ks, Roth IRAs, and also Roth conversion strategies are the things that begin to come into play here. Another class that I teach sometimes is about tax-free income. And the motto in that is zero is our hero. And there actually are ways to move yourself to a zero tax bracket. Now, it's not that you're going to avoid those taxes, it's you're going to pay them when you're in a more favorable situation. So again, I want to emphasize that we're not only talking about income planning, but when we're doing that, we have to consider the tax. So there are some things that you can do. You can look at your charitable contributions and so forth, but it's really important that you get a handle on the last line here. It says any source of taxable income. You need to identify those and need to talk those through and be sure we have those right. Okay, so the next things we're going to talk about are spousal benefit, file and restrict, do-over strategy, and start, stop, restart strategy. When we're doing seminars in person, we generally have a little break now for people who need to take breaks. So I'm actually going to do that here. I'll just pause for a couple of minutes. If you need to step away and come back, I won't go forward until we have about a 2-minute rest here. Okay, so at this point in time, well, if you're not leaving your computer, you might want to check the chat boxes to see that you have any questions. You put them in there. And if you also decide that you're going to request a consultation, take a look at the link there so that you can get that scheduled. So we'll just be a little bit longer here to give people the time to take that little stretch they may need now. And get back into our time together. We've got a few more things that we want to talk about. So let's dive right into spousal benefits. Okay. In order to claim a spousal benefit, you must be at least 62 years old or have a qualifying child in your care. You have to have been married for at least 1 year. And by a qualifying child, we mean a child who is under the age of 16 or who receives Social Security disability benefits. If you elect to receive a spousal benefit before you reach your full retirement age, your spousal benefit will be permanently reduced unless you have a qualifying dependent child. If you claim a spousal benefit before you reach full retirement age, you will not be able to switch to your own retirement benefit at a later date. So that has caused some problems for people in the past. Okay. Whoop, I hit the wrong button. And what we want to be sure that you understand, again, I mentioned this earlier, but the bill, the Bipartisan Budget Act of 2015, included some very significant changes to Social Security benefits, most notably the elimination of the most commonly used maximization strategy, which was called file and suspend. The last use of that was 4/30 of 2016. File and restrict had its last use 1/2 of 24, except for will have I'm sorry, the last use of January 2nd, 2024, except for survivorship benefits. So a detailed list of those changes can be found in, well, if there were a workbook, if we were here, I'm sorry I didn't catch that. I can give detailed information on that for anyone who needs to see that. We have that in a printed format. I didn't realize that that was there. Okay. All right, so let's move on. Here's something that's quite interesting. If in the event of a divorce, okay, if you're divorced, you may be entitled to Social Security benefits if you are at least 62 years old. You were married for at least 10 continuous years. You are unmarried, and your ex-spouse is entitled, okay? Meaning has filed for some benefit. You may be independently entitled without your ex-spouse being entitled if your ex-spouse is 62 or older, your divorce has been final for at least 2 years, and your own worker benefit would be less than 50% of your ex's primary insurance amount. Okay? So spousal benefits must be higher than your individual benefit would have been based on your own work history. This does not, now, I can imagine that people who are divorced are saying, the last thing I want to do is to contact my ex to find about anything involving this, okay? It is not necessary, okay? It does not affect the benefit of your former spouse, what he or she would receive, even if that person has remarried. And even if that person was married to someone else for more than 10 years and that person is also claiming. I don't think that happens very often, or they would have done something about that. But it's important that if you are claiming the benefit and you remarry before age 60, you cannot do this, okay? You cannot claim this ex-divorced spouse benefit. If your ex-spouse is living and all of the caveats are met, you may be eligible for up to 50% of your spouse's PIA. If you file your claim before your full retirement age, your benefit will be reduced, okay? So again, I don't want to spend a lot of time on this because it gets pretty confusing, but if you have been divorced, even if your ex-spouse is deceased, it's worthwhile to mention that. If you're going to have me do an analysis, it's worthwhile to mention that so that we can consider that, because oftentimes people are entitled to a benefit that they are not aware of being available to them. Okay, so the Bipartisan Budget Act in 2015 also extended the impact in the same way that it did to married couples. So if the divorcee is independently entitled, then voluntary suspension rules do not apply. Access to restricted application stops for those born on or after January 2nd, 1954. Again, this is sort of an individual circumstance. So let's move on to survivor benefits. If you are widowed or a widower, you're eligible to collect your own benefits or 100% of your deceased spouse's benefits, whichever is greater. If you are at least 60 years old, you may collect, but you will have a reduced benefit prior to full retirement age. You must have been married for at least 9 months or 10 years if you're divorced, okay? So receiving a divorce survivor benefit, you must have been married for 10 years. If you're currently married to someone, or you were married to someone, not divorced from them, you were married to them for at least 9 months, you may be eligible for the benefit. And you must remain unmarried until after the age of 60. Notice what it says there, remain unmarried till after the age of 60. If you remarry after the age of 60, you do not lose that benefit, okay? And again, there were some changes that came about with the bipartisan budget act. I'm not going to go into those because there are more important things to talk about. And one of those is the maximizing lifetime and survivor benefits is critical. Okay, as we all know, we're living longer, and as every year goes by, we have more and more people living to the age 100. Another important thing is statistically, women outlive men by 5 to 10 years. That's just the way it is. So it's important to pay attention to your family history when you're considering collecting your benefits. Okay, you want to guesstimate. Okay, so I don't know how long I'm going to live. You don't know how long you're going to live, but we can make an educated guess based on longevity in our family. Okay, so we're going to look at this in the context of planning for retirement to understand that at least one, if you're a married couple, at least one of you is going to live statistically 30 or more years. So in your distribution plan, you should plan conservatively to make sure that your withdrawal rate is not too aggressive. Okay, what is too aggressive? Well, anything above 4% may be considered too aggressive because of longevity. And when the 4% rule was put into place, the life expectancy was around 79. It's creeping up, okay? And what we find in our practice is that we have many couples that later become a single because one has passed on, and the survivor lives 10, 15 years beyond that. So in some cases, 20 years beyond that. So we want to be sure that we're not withdrawing too aggressively on the other facets of our portfolio. Again, it's important to coordinate this, not just with not knowing your Social Security benefit only, but coordinate it with other sources of income. But there is still a benefit that we can take advantage of in many cases, and that is the restricted application. That's a great way to not only maximize the benefits for the surviving spouse, but to also collect some extra benefit while the higher wage earner is earning deferred election credits. Okay, so let's take a look at this. Okay, Joe and Cindy are eligible for full monthly benefits of $2,416 and $982, and that's what Cindy's individual benefit. Her spousal benefit, however, is $1,208, which is half of Joe's benefit, $2,416. Okay, and that's at age 66. If they both retire and claim benefits at age 66, they could receive a total of $1,392, a benefit, sorry about that. They could receive a lifetime benefit of $1,392,459 over the next 24 years if they both live to age 90. It's about $58,000 per year. Now, alternatively, Cindy could file for her benefits at age 66, and Joe could then apply for a restricted spousal benefit at his age 66, which provides about $491 per month, 50% of Cindy's $982 benefit. The total payment from 66 to 70 would be $1,473. You notice that that's more than if Cindy had just collected her spousal benefit. It's more by $265 a month. Then at age 70, Joe would elect his own Social Security benefit, which provides about $3,434 per month. And Cindy would automatically get her spousal excess payment now that Joe has elected, which provides $1,208 a month. Now let me point out there, the $1,208 is not based on what he's claiming at age 70. It's based on what his full retirement, his PIA was, okay, at age 66, $2,416. Okay, now that strategy could yield this couple a total of $1,545,026, or $64,000 a year. And over 24 years, that's an additional $152,567. Choosing the wrong retirement strategy can cost you hundreds of thousands of dollars. So, of course, this is hypothetical, and actual situations will vary, but I think what it is showing you more than anything else is what the opportunities are. Okay, I'm sorry I did not click forward to this slide. Okay, this slide is showing, while I was explaining it, this slide is showing you the actual map on that. Okay, so what about a do-over or a reset? So once in a lifetime, maybe after attending this meeting today, you may say, oh my gosh, I filed in June and now I realize I shouldn't have done that. Okay, so within the year of when you initially filed for benefits, you can say, take me back to where I was, I don't want to receive the money. However, you must pay back all the benefits that were received, and for both the individual and the spouse, if applicable. Okay, there's a Form 521 to request a withdrawal of an application. Now, I have a very, very savvy client who made this error and said, I determined that if I have some of that money, I don't have it all, but if I took that money out on my credit card and paid it back, blah, 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 this is what would happen, and doggone it, if he wasn't right. He needed to get about $18,000 more to pay it back, and when we went through the math, it actually worked. It was a lot of figuring. It wasn't anything that I actually would have thought of myself, but it's important to know that you can do this, and if you do do it, then you want to reset to do it right and be prepared to pay everything with the request. Okay, you have to send the check with the request. All right, start, stop, restart. If you are full retirement age, but you've decided, you know what, based on what I heard today, I think I want to stop my benefits. You can stop them. You can restart them at any time. They will grow by 8% per year until age 70. And if your benefits are not restarted until age 70, the monthly payments, if you were age 66 when you did this, will be 32% higher than at full retirement age, and that will be for life, plus cost of living adjustment. There is no additional growth beyond age 70 except for cost of living adjustments. So now what? Okay. So now you need to take this information and put it in context and say, will I outlive my money? Okay. Baby boomers and Gen Xers are projected to lack adequate income for their basic retirement and healthcare expenses. I hope that that's not the situation that you're in, but you need to look at this. You need to determine a strategy that begins by asking, what are my income needs? Okay. When we work with clients, the first thing that we want them to do is to give us their income and expense, because it's not uncommon for people who have good incomes to live, I'll call it paycheck to paycheck, although that has a negative connotation, but they'll have a tendency to not pay close attention because there's always enough money and then some to cover their needs. When we start to look at retirement income, we need to close in on that. We need to know, what are income needs? And do you anticipate them being the same in retirement? Will they change in retirement? And how can you close the gap between your fixed sources of income, like Social Security, and the other resources that you may have? So how can you do this? Again, you need to evaluate the other sources of income that you have. You need to look at your retirement accounts. Now, there are pros and cons. I almost think this is like putting up the fence after the horses have run down the road. But if you're using a 401k or an employer plan, you have a potential for matched funds from an employer. You maintain some or all control over your account, and it's tax deductible when the contributions are made. The con, of course, is if your money is invested in the market, you have a potential loss due to market risk. It's fully taxable at distribution, and you take the risk of investment decisions and income distributions. Okay. So I want to speak to this for just a moment and say that if you are still working, plan to continue working for several years, and maybe you're 65 years old, but you have no plan for retirement, you may want to look at the cost of deferring, because it may be more expensive tax-wise for you to defer. You may be deferring to a higher bracket in retirement. So you want to be sure you take a careful look at that. And also the other thing that we want to do is to be sure that we're aware that required minimum distributions now are not required until age 72. And if you are currently retired and subject to RMDs, they're not required in the year 2020 because of the financial chaos that we have been through. Okay, so the principle here is that we want to be sure that you are looking at these sources not only from what can they provide, but how will it be taxed. Okay, there are also defined benefit pension plans. Okay, that's something that's been fully funded by the employer, not the employee in most cases. They're simple, and the benefit is a known amount. The downside of that is there is only one plan. You don't have a say in an investment, and they're mostly not adjusted for inflation, and they're fully taxable. So that, again, is something that you need to take in consideration for doing your planning in retirement. Okay, defined benefit plans are a plus. You just need to know where they fit. Okay, now there are investments, various kinds of investments. We're going to go over a few of them here. Nothing is specific, but they're the generic terms. Dividends and interest from stocks, bonds, mutual funds, CDs, etc. Okay, the pros are you maintain a control over your account. You have a potential for tax advantage forms of income. You can manage long-term capital gains in many cases, and taxes are paid on earnings only as long as you haven't sold your positions. The cons are you still have to pay taxes. There is a potential loss for market risk that has to be considered, subject to reinvestment risk. Of course, there's no guarantee of principal protection, growth, or income, and you take the risk of investment decisions or income distributions. That doesn't mean they're bad. It just means these are all things that have to be considered. Okay. Then we get into investment or retirement income products. Okay. There are annuities. They are deferred annuities or immediate annuities. Annuities are much like automobiles. Okay. And that is to simply say I have an automobile doesn't give you a whole lot of information as to what that is. You need to know the difference. There are variable annuities, there are fixed indexed annuities, there are indexed annuities, there are fixed annuities, and there are immediate annuities, okay? The annuity may have an income rider. And oftentimes people say, I have an annuity, I don't really know what it pays, but I have it, okay? Well, it's time to find out what it does. Okay, the pros are you maintain control over the account until you have done annuitized, if in fact you ever do that. That's a whole nother subject that I'm not going to address today. If non-qualified, tax deferral on annuities, there's tax deferral on annuities, and there are no mandatory distributions if they're non-qualified, meaning that you bought them with after-tax dollars, not in an IRA. They do have a potential for guaranteed principal, growth, and income for life. And that's why most people buy them, to create what we'll call a private pension. Okay. The cons are mostly as long as you're looking at the product that's mostly applicable to you, or that is applicable to you and appropriate for you, I mean to say, they often require a longer term commitment. And they absolutely, not they often do, they do. Okay, that's the real answer there. Okay, and then the other source that people use for income in retirement is permanent life insurance. If they have whole life or index universal life, they may have cash value that they can access on a tax favored basis. Term life is not in that category. The term life is exactly what it appears to be. There's a term in which you're insured, and at the end of that term, you either pay a substantially higher premium or you lose the coverage. The pros for using life insurance are you control your account, you have income tax-free loans and withdrawals up to the cost basis. So it's a very strong tax planning vehicle. However, there's a caveat we'll get down to in the cons. There are no penalties for early access. There are no required minimum distributions. And if you don't use it while you're alive, your heirs will receive a leveraged death benefit. The cons are it takes time to get a plan up and running. So it really takes careful planning to see if that's something that fits into your planning. Okay, so what do you do now? Okay, you need to begin now to plan for a comfortable retirement. So all of these instruments that we mentioned there can be used to create retirement income that you might need. Structuring that, however, is where the work comes in. The key to your success, and I'm sure you already are catching on to this, is careful planning. But there are actions that you can take right now that will help you maximize your Social Security benefit and fund your retirement income effectively. Again, understanding, remembering the horses there, whether or not you should be using assets or your Social Security, at what time and so forth, is an important decision to make. Now remember, most of all, that you're entitled to a consultation to get more personalized information and have any questions answered. You can take advantage of that strategy session by clicking on the link in the box. Okay, at that point in time, I want to be clear that you understand that you can crunch the numbers, I'll crunch the numbers, and calculate how we can help you. Okay, but there's an important bit of information that we need. You must have your Social Security statements. Okay, you need to have those available for that phone call. What I will ask you about is your age, your date of birth, and that Social Security information, specifically your PIA at FRA, your primary insurance amount at full retirement age. With that, I am able to do that analysis for you right while we're talking on the phone. Okay, so again, it's in order to get the full benefit of that, I'll do the analysis and provide that information to you. I'll email it to you, and I think it will be a very, very valuable thing for you. So remember also to click on the evaluation form. Let us know how we're doing as AFEA instructors. AFEA is interested in knowing that.